Canadian success story. Starting from its humble beginnings as a one-shop operation, it is now one of the largest construction equipment distributors and providers in Eastern Canada. And now it is faced with the incredible opportunity to expand its small operations in Alberta in order to take advantage now of the future but uncertain recovery of oil. Good morning, my name is Angelica. I am pleased to introduce my colleagues Marissa and Liam, and we are so excited to be here today to talk to you about how you can best expand your operations to conquer the West to ensure a long-term sustainable growth strategy.
Great, thanks Angelica. So let's dive right into what we're going to talk about today. So the primary issue that we've identified is the fact that your company, Garamond, is needing a sort of expansion strategy to move into the West. So we're going to go about and have a look at three different options. We've got the market industry outlook, and within the expansion or exit opportunities, you've provided us with three different options, as well as some other considerations to talk about. And finally, we're going to examine how that will have an effect on your financial statements as an impact. So today, we recommend that you purchase a local rental chain in interior BC as the fourth option that we're going to be presenting. And this impact will have a long-term growth strategy resulting in an implied shareholders' equity of 25% of the project. So moving first into the issues analysis, these are the four options that we have. So first, you can increase rental store networks in two ways. In Fort McMurray, we're going to be either looking at purchasing a local rental chain or building your own rental shops. So there's the two options to increase it in Fort McMurray. Or you have the option of actually exiting the market and selling the two current stores that you have in place. And the fourth option that we propose is actually doing a combination of the third, of not only selling the two stores that you have, but also expanding to interior BC in order to pursue your strategy in the West. So in today's decision, we're going to be evaluating all of these options on three criteria. The first being financial return, the second on the market risks, and the feasibility of implementation. But before we take a look at any of those decisions, we're going to have a step back and examine what the market and industry outlook is for the future. So Garamond Construction, for the company itself, it's a provider of new and rented construction equipment, and with 30 locations in Canada, in Ontario and Quebec, most of that is centralized in the east. So you've only got two current stores in Alberta, and in the past that was actually 5, but you downsized due to the fact of the market going under. So what's interesting with your company is that you have a strong relationship with Komatsu, which is the manufacturing company that you distribute for. And this company is actually the world's third largest in manufacturing for construction equipment. So with that being said, Komatsu has a large bargaining power over your company. The customers for Garamond Construction include real estate developers, landscape firms, and infrastructure construction. So all of these have a tendency to actually rent their equipment as opposed to buying, simply due to the high cost, anywhere between $150,000 and $1 million. In terms of your competitors, they provide similar offerings in terms of equipment, but the main difference is that you distribute for the manufacturer Komatsu, whereas your competitors distribute for other competitors. Each of these competitors actually have 15 to 20 locations in the Fort McMurray area, making it that they have a large market presence compared to yourself with only 2 current locations. And your major competitor is actually Redwood Limited, in the fact that they're the second largest distributor, whereas you're the first. When we examine the industry as a whole in this area, you must recognize that the health of the construction equipment industry is actually very cyclical because it's dependent and closely linked to the oil sands development. So some of the opportunities in this industry is the fact that if the oil prices do recover, as they are currently going under, you will have the potential to actually rebound with the construction industry. But the fact that the market is not yet dominated by other major manufacturers is the fact that you actually have a growth opportunity to continue expanding with Komatsu. However, at this current time, the demand for new and rented equipment, construction equipment, is expected to fall over the next 2 years. So even though this is still considered short term, there's a large uncertainty in this market, and you really don't know where it's going because it's closely linked to the oil sands. So when we look at these 4 different options, we're going to examine them both on a qualitative and quantitative aspects. So with the first option of purchasing a local rental chain in order to expand the stores in Fort McMurray, the pros to this option is that you have the opportunity to grow with the manufacturer. They really want to expand in the West, and being the world's third largest manufacturer, they have a large market share. So the fact that you get to expand with them is significant, and they are also offering financing of 70% for you. So you have a favorable interest rate, which is provided at 2.7%. And at the same time, by purchasing stores, you do get to gain large market share due to the fact that you're acquiring established companies as opposed to the other option, of which is starting up your own companies from scratch. However, on the flip side, there will be a high premium to purchasing any of these local chain stores due to the fact that the owners are unwilling to sell. So this results in the fact that you may be overpaying almost 6 to 7 times the pre-tax earnings. So with the potential of not actually recovering any of the oil prices, this could be detrimental to your cash flows in the future. And lastly, a con to this option is that right now you have 30 successful core operations in Ontario and Quebec. So having that distance in Alberta could distract you from focusing on where you are currently successful. And now we're going to examine the financials to this aspect.
So diving into the numbers, for the first option of Transverse, the total revenues are expected to be $83 million. This is based on a 3% long-term growth, which we feel is very applicable because the current decline and very repressed market in Fort McMurray for this. Additionally, there's been a lot of capital expenditure already, so the need for additional capital expenditure won't occur until the oil prices rebound significantly, because they're currently approximately $30 a barrel, and that is even less than a year ago. Additionally, this does include the 7 multiple applied, and it has a free cash flows to equity of negative $17 million. We feel this is the best way to analyze this because you are able to get a line of credit, and it's your choice to take on the financing costs. As a result, this should be factored into the decision going forward to figure out the return on the investment and the return on acquiring these companies. So as you can see, the ROI, given a 7 multiple, is actually significantly negative. Going forward, we'll actually look at the spreadsheet and how we got to this. So as you can see, the total financing costs annually are $12 million. This is very important because although the interest payments are significantly lower, if your goal is to continuously expand, to continuously prosper in the West with your stakeholders, you'll have to pay down your line of credit as you're going along. So as a result, we factor this over the 5-year time period because that's what you've indicated for these projects. As you can see, valuing this on free cash flows to equity is the best way to establish the profitability for this project in the long run, because you are going for sustainable profits and sustainable cash flows to your company. So looking at the next slide, we also applied, you can see that there's consistent negative free cash flows even though there's positive profit. This means that in the long run, this won't be sustainable. So option number 2 is also, or another option is purchasing Caldon. Again, the initial outlay and including the financing costs, it's similar to the first option, indicates a negative ROI. We did apply some multiple, and even if the multiple drops down to 3, it is still negative overall. And we did do that in our calculations, which we can discuss later on. And the last one, Vanguard, which does have the smallest purchase price and the less free cash flows to equity, or the least negative, is still a negative ROI over this 5-year horizon. As a result, all 3 options will not generate positive returns on your investment that you initially have to put in.
So what we've looked at was the first option. You've got 3 target acquirees, and we examined the financial impact of those. And now we're going to move on to the second expansion opportunity of building your own rental shop. So some of the good sides of this option is that you have the flexibility due to the inherent nature of building something from scratch. You can choose the specific location of where the demand is expected to grow, as opposed to having the shops that are already established and having to buy them all wherever they are located. But at the same time, because it takes such a long time to build, there is not really that short turnover of the same aspect of if you were to acquire shops as opposed to starting them up from scratch. And in fact, if you were to build your own shops, you would actually have to send over 10 employees from your Ontario locations to do the setup. So that opportunity cost is actually rather high, because now not only are they not focusing on their core operations, but they're also having to manage this new operation that they haven't really had experience of before. And lastly, because you are only able to build one shop at a time as opposed to acquiring a large bunch of them, you won't be able to necessarily gain market share as rapidly as you would like. And given the fact that most of your competitors in the area already have 15 to 20 locations and you only have 2, that is a significant disadvantage.
So quickly looking at this graph, as you can see, we have your current projections of revenue and we've adjusted them for the long-term growth strategy that we feel is applied. Your first year revenue growth is increased by 50%. However, the biggest takeaway is that you will not generate positive pre-tax profit until the 4th year, regardless if you have the adjusted sales figures or not.
So examining now the third option of actually exiting the Fort McMurray option and just selling all of your stores, the 2 stores that you have, we see that this is actually a good thing in the fact that you're avoiding the risk of it being connected to the oil sands and if the prices were to continually not recover. And you also can focus now on your core operations in the east. So, but at the same time, with any risk you might be missing on the potential upswing of if this would simply be a short-term turnaround time period, and the fact that Komatsu will actually partner with your competitor Redwood in the Fort McMurray city simply because now you're exiting the market.
So quickly looking at the financials for this, that the free cash flows are constantly negative. So going forward, we're actually recommending that you sell these based on an earnings multiple applied to pre-tax profits. On the next slide, you can see that based on a multiple of 3, 5, and 7 are the generated revenues and cash flow incoming that you'll be able to get for these 2 companies. As a result, based on a multiple of 5, you'll generate $5.8 million if you're able to sell it on that.
So with that being said, while we are selling the stores that are in Fort McMurray, you still want to expand to the west. So we're examining Interior BC as a good option to pursue, not only because you're avoiding the risk inherent of selling and exiting Fort McMurray, but you're also moving to a location where real estate developers, your customers, are actually growing. You're no longer dependent necessarily on the cyclicality of the oil sands, and this actually shortens your supply chain, being closer to Japan, so you're closer to your manufacturers in that sense. So Interior BC is sort of an appealing option to us. The same cons apply, the fact that you are further away from your headquarters in Ontario, but at the same time we recognize that Ontario and BC may have more similarities in the way that businesses are run.
So quickly looking at the financials, we established the total potential cost on being able to sell those Fort McMurray offices for $5.8 million, getting 70% financing for your line of credit, which results in interest payments of $297,000. We got the pre-tax profit per store based on the average of the stores in Fort McMurray and your own stores. As a result, you can acquire 4 stores in BC at a multiple of 4, which will then give you a return on equity of approximately 25% for those stores. Which, as you can see, the implied equity value, as I mentioned, is $16 million. The pre-tax cash flow for all those stores is $4 million. So your pre-tax return on equity is approximately implied 25%, which is above your current 9% of your current operations. Additionally, these 4 stores will make your total pre-tax revenue approximately $31 million, increasing your total pre-tax revenue by between 12 and 13%. So looking at our overall recommendation, the financial return in the long run is not significant for both purchasing a local and building your own. As a result, we're recommending that you exit Fort McMurray and use that generated cash flows, use that equity that you're getting from there, and expand to Interior BC. This is, as Marissa mentioned, the market risks are far more favorable in BC, as well as there's significant more feasibility of implementation, which Angelica will discuss further. So our overall recommendation, as I mentioned, is both sell your current operations for approximately $6 million, acquire a local chain in Interior, approximately 4 stores at a valuation of 4 times their pre-tax earnings, and as well finance this through that equity you're getting and using the line of credit.
I'd now like to talk about the financial statement impact in terms of accounting policies relating to this acquisition of the local chain in Interior BC. So because you are acquiring 100% of the local chain, you will have to consolidate it by treating it as a subsidiary. Since you use IFRS, an important factor is determining the goodwill, which is valued at the excess of the consideration paid over the fair market value of net assets. So you will have to determine the fair market value of the assets and liabilities and find the goodwill from there. This goodwill is tested for impairment yearly and can only be written down. And finally, the acquisition differential, which is the total differences of the fair values of net assets compared to their book values, is amortized over the life of those respective items in relation to the associated depreciation method that has been applied to those items. I'd now like to go into how you can implement this project. So right now, it's September 2015, and the first thing you have to do is to sell your 2 Fort McMurray stores in order to proceed with this project. Starting in October, you will need to do market research on Interior BC so that you can determine where the best locations are to implement this project. You will acquire the local BC chain, which we estimate to be around 4 stores, so a smaller option. And starting in February, you will begin your marketing campaign to the businesses that you hope to sell to before you even launch, just so you are able to gain those key customers right away. In February as well, you will relocate your management because we want the same control over the operations as you have in Ontario and as you had in Fort McMurray, Alberta. So we suggest relocating management that will no longer be in Fort McMurray because they are closer to Western Canada, so they will be more open to that, and as well relocating any employees who are willing to do so as well. And finally, you will need to retrain the employees of the acquired local chains so that you can instill the values of Garamount in them and bring them up to speed on what your policies and services are. And at the end of April, you will launch the local retail chain stores, and we time that to be starting at the beginning of summer and spring because that would probably be the high season for construction and development. In terms of costs for this implementation, we estimated market research to be around $20,000 to research Interior BC, and the transaction cost for the acquisition is approximately 1% of the purchase price, and the marketing and human resources costs, which include training, your employees, will be around $75,000 in total. So just to go into more detail on some of these key activities. So firstly, the market research would probably be very inefficient and ineffective to do it yourself. So we recommend hiring a local market research firm that can give you very customized information on what the best acquisition opportunities are and where the most promising areas of demand are in Interior BC. For the marketing campaign, since it is a business-to-business deal, you can exhibit at industry shows and trade fairs leading up to the launch of your chain so that you can demonstrate the products. This will help you develop those key relationships and those key accounts so that when you start, you'll be able to generate revenue right away. Finally, to retrain the employees, we recommend that you have them trained by Garamount managers, and this will help align them with the Garamount culture and provide them with the best knowledge on how to sell the technical Komatsu equipment to the customers. In terms of risks, there's definitely the risk that Komatsu will not accept expanding elsewhere other than Fort McMurray. They might want to take the risk and invest in Fort McMurray now, hinging on the recovery of oil. To mitigate this, you can leverage your long-standing relationship with Komatsu by emphasizing the long-term, more predictable market favorability of the Interior BC market compared to Fort McMurray, so that they will be able to, are more willing to invest in this project. And because there might be the risk of you having that opportunity cost if the oil price does rebound, we suggest you continuously monitor that market because it probably won't rebound in the next 2 years, and monitor the 3 potential acquisition targets for potential expansion in the future after you move into Interior BC.
So we've talked about a lot today, but we just want to recommend.
Thank you all. This concludes the presentation. The 5-minute question and answer period will begin now.
To start with, I guess, we still have the same issue whether we're looking at buying some new firms in Alberta or whether we're looking at buying new firms in BC. We're looking at switching the company that we're using as our supplier. So we have Komatsu, the business we're buying might not be. And so some of that goodwill that we might be getting, those customers, if they're loyal to those other brands, they're not going to want to stick with us. How are you suggesting that we're going to handle that issue with a new business in Interior BC?
Right, so if we were to purchase a chain store in Interior BC, there would be the switching costs associated with introducing the Komatsu equipment, but we think that not only would we be able to provide what is currently offered, but in addition to offering the manufactured by Komatsu, you'd have more varieties for the customers, so you'd in fact have multiple offerings of the different construction equipment.
A quick question. I'm just looking at the implementation plan, and I think that you propose that we initially sell our Fort McMurray stores before we go out and do market research on
Yes.
Interior BC. And just thinking in my head, what if we find that we don't want to pursue the BC option based on the market research? Was there a reason that you proposed that we sell immediately versus doing market research first?
Yes, so what we recommend for that is that the market research for Interior BC relates to the specific acquisition opportunities, but of course if you wanted to do more market research on the industry as a whole, you could do that before selling the stores. And the reason that selling the Fort McMurray store begins so early is because it takes a long time to find buyers, and so you don't actually have to sell up until the end of October when you're sure that the market research proves that Interior BC is a viable market. So the range of when that selling time could happen is flexible depending on what your research finds.
Would you consider the preferred dealer status and the relationship with Komatsu in terms of the sensitivity of exiting Fort McMurray and going to BC? And so said another way, are we confident that Komatsu would be comfortable with us going into BC when we're not addressing one of their key asks?
Yeah, so what we've done is we've presented that actually going to Fort McMurray is not going to generate a positive return. And their main objective, their main goal is to expand west. So what we feel is shorting their supply chain, because most of it is manufactured in Japan, will actually lower transportation costs, and your long-standing relationship with them, building that relationship involving all the stakeholders will not only set you up to prosper in the short term, but help you achieve excellence in the long term.
I have a question. Since you're recommending that they sell and start their new stores and their training of their employees, are you confident that Garamond has the capacity in their current employment situation to transfer 10 employees, or the amount of time and training it takes to move into the new location?
Sure, so the figure for the 10 employees was actually if you started those operations from scratch, not acquiring a local retail chain. So we feel that by acquiring a local retail chain in Interior BC, you lessen the demands on your management because you already have the existing employee base of that company. And you could easily relocate the management and employees that are in Fort McMurray, Alberta, to Interior BC so that you don't take away the core focus from your operations in Ontario.
One question about the BC plan, and it would be an implication in several of the options. How does taking Garamond into a selling environment where they are now selling competing brands versus a single brand? Like, how does that impact Garamond's style of operating?
So their current style is primarily through rentals, and the biggest takeaway that we have, which also relates to capacity and relating to be able to meet the customer needs, is that acquiring only 4 stores over your current 32 is a very marginal increase. However, if you go with all the other chains, you're either acquiring 15 stores or 20 stores. That's over 50% of your current operations, and your current operations are back east. So if you're being able to meet those capacity, you'll still be able to send those managers, as Angelica addressed, train them properly with your current style, and be able to meet your customers' demands.
Okay. We had a few more questions.